live and we're back. Coverage Your podcast. Late afternoon, still in pandemic times. Welcome. I would like to introduce my guest, Robert Smithson, founder and CEO of Just Auto. Welcome.
Hi. Nice to be here. Thanks, Nick.
Yeah. So we live in these interesting times. You just had to lock your door so nobody would come in. I have to do the same behind me. How are you?
The answer is I'm doing pretty well. I'm very lucky. If you're going to be forced to quarantine anywhere, Los Angeles is definitely one of the better places to be quarantined.
There you go.
As is Florida.
Yes. Yeah. So we were just discussing that, and you know, there are worse places. I just moved from New England, and it's the middle of April, and they just got 4 inches of snow. So no bueno. Glad that we're in warmer weather. We can go outside occasionally, get a breath of fresh air. And I understand, I just read that the skies in Los Angeles have never been bluer.
That is certainly true. Unfortunately, from the perspective of an auto insurance company, the reason, or at least a per mile one, the reason they've never been bluer is because no one is driving.
Yes.
Which is both the strength of a per mile product, which is great for customers, but a negative because we do quite like premiums.
Yes. And we're going to talk about that. We're going to get into your business model. So you kind of already jumped into it. Can you talk about Just Auto? Who are you and what do you do?
Okay, so Just Auto Insurance is another next generation usage-based auto insurer. But there are a couple of things that make us different from a Nobler or a Root or a Metromile. And I think they come in two halves. Firstly, our business model is different. And secondly, our customer target market is different. So if you look at our business model, we are pure per mile. So we don't have a monthly element at all. Now that may change in future when we start adding full coverage, but for liability only, it's straight per mile. The second thing that's unique about our business model that comes out of this is that we don't really have anything that looks like a traditional contract term. What we give you is a price that is good for 30 days. As you drive, we change the price every 30 days. So our contract length is just 30 days. So the way it works is you load up your account with, let's say, $30. We give you an initial price of, say, 10 cents a mile. And as you drive, we learn more about you. And then in your second month, should you choose to stay with us, we give you a price that is a combination of demographics and driving data or telematics. What this means is that compared to somebody using discounts, we have a much greater ability to flex our pricing in response to driver behavior. The second thing that's interesting about this model, of course, is that it requires very little commitment on behalf of a customer. They're not entering into an annual contract. They're not going to have $100 taken out of their account at the beginning of every month. If they're not driving, they're not paying. And that's quite appealing in this sort of COVID-19 period. So that's the first thing. It's a slightly different business model. The second thing, which is very unique about us, is if you look at pretty much all the other UBI telematics-based guys, they're all focused on what I might describe as better off consumers. They like people who have good credit ratings. They like people who live in nice parts of town, who drive nice cars. They're probably like your part of Naples. We're focusing on lower income consumers. And that's for two reasons. Firstly, it's a big untapped market. And there are lots of people in the United States that don't have insurance because getting even minimum liability insurance is expensive and difficult. And we really lower the barrier to getting it. And the second thing is, if you think about it, the group of customers who would benefit most from telematics priced insurance are lower income customers. Well-off customers are not going to change their driving style to save $20 a month. We believe that lower income consumers who face many bigger constraints on their income, they will be. And so we think it is particularly well suited to that demographic.
How do you do it? What's the tech?
Okay. How do you do this tech? So our technology probably doesn't look a million miles different to a route. So you download the app. You download the app, you go through a very quick onboarding process. We have a total time to insured of less than 1 minute. And that's because our telematics pricing element means we don't need to know so much about you. We're only living with the price we've given you for 1 month. So we can say, okay, Nick, what sex are you? How old are you? What's your zip code? Do you have any accidents, claims, or violations? And in fact, so we're just implementing right now on our website an instant quote facility. No need to enter any details about yourself. No need to enter your email address. Literally, just it's all there on one page. Just under 20 seconds, you can get a quote. And that's your quote for the first month. Now, as you drive around, how far you drive, and we learn things about how you drive. And that enables us to set the price for the next month. The metrics we use, they're probably very similar to other telematics players. We think we have some secret sauce. Some of the secret sauce is secret. But I mean, let me give you a couple of small examples. We use data on where every traffic signal is in the United States. So we then look at the GPS track of our customers, and we then look at them as they go through traffic signals. And so we look at the traffic signal and say, does this customer, does Nick, if he doesn't change speed when he goes through the traffic signal, that was probably green. On the other hand, if he slows down when he was 100 meters away, 100 yards, sorry, it was probably red. For those other ones, what's the point at which he chooses to either accelerate to go through or press the foot down to stop? And we can work out, actually based on statistical analysis, how aggressive you are in trying to beat that yellow signal. Because our view is that people who are aggressive and trying to beat the yellow signal are more likely to have accidents. And this is actually really interesting because it comes down to the point about our monthly pricing element. And that is traditional telematics-based offerings. They work about giving you a price and a discount. So they can only give you a fairly narrow range of probabilistic outcomes. You might save a third. So there's only a small range of probabilities.
Right.
But the reality is a safe driver is 10 times or a tenth as likely to have an accident as a dangerous driver. And our model allows us to express that wide range of outcomes because we're able to change our pricing regularly and eventually move to something that is essentially all telematics based.
And so if I understand this correctly, there's nothing to plug in. You're using
currently nothing to plug in. We are going to offer an optional dongle because the more we look at things, the more interesting stuff we discover. So I want to know if your brake pads are worn, because I want to be able to tell you that if you change them, I can cut your insurance rate.
Yeah. So plugging into the health and well-being of the vehicle also contributes to whether there might be an accident, because you'll know ahead of time whether there could be something wrong with the brakes or some other aspect of the vehicle.
Exactly. And you can see whether tires are underinflated.
Yes.
It's interesting because, it's interesting you said, you kind of got it straight away. A lot of people think of the OBD2 as giving you telematics data about the driving skill. The reality is the phone tells you almost all of that you need to get. But the health of the car has a huge impact on the likelihood of an accident. If your car is not capable of stopping quickly, then no matter how skilled a driver you are, you could cause an accident.
Yeah. No, that makes a ton of sense. So where'd the idea come from?
Okay, so my background is I started a bunch of companies. We were talking before this call about a business that I founded called Python Anywhere in the software as a service space. But the biggest sort of project of my life was a sports technology and sports data company called Genius Sports. And what Genius Sports did was Genius Sports priced the risk of sporting events happening, by which I mean, and I realize that, I'm going to talk in the language of European soccer because that's mostly what we did. But they use technology to judge in real time which team was the next one that was going to score, the most likely, which player was the most likely to score next, what the end score from a game was going to be. And that allowed people at sporting events to use their smartphones to wager on them as the event was going on. And that technology, that real-time pricing, when we looked at auto insurance in the US, because I sold that business, I noticed how unsophisticated those models were. And I thought it was a fantastic opportunity to take what I'd learned in pricing up sporting events and moving that to auto insurance.
Yeah, no. So that's the same technology where it gives like the probability of winning.
Exactly.
Yeah. Oh, that's interesting. So, but do you remember the time where the light bulb went off in your head and was it a moment of frustration? Like how did you end up locking into insurance? How did you end up seeing that as potentially the inefficient model that could benefit from this type of technology that you were developing?
Well, I think it was when I went to try and get auto insurance myself, because I'm a relatively recent immigrant to the United States. I came here in the summer of 2017, so three years ago. And of course, you come to the United States and you don't have a credit rating, which I hadn't realized until I got here was the single most important thing that any American can have. And of course, that impacts your insurance rate in the US. And so, you realize that this is an incredibly sophisticated system that American insurers have created, but it's incredibly sophisticated at working out the risk of a group, a population. But individual risk is not the same as average risk across the population. And what the light bulb moment was the realization that with modern technology, we can look into the car and we can see the person driving and we can understand the real risk of that particular driver at that particular moment on this road, not just looking at, no matter how sophisticated, what the average is for the group.
Yeah. So classic experience, right? A buyer goes to purchase a product or a solution and is completely dissatisfied and says there's got to be a better way.
Exactly. The irony is, Nick, that I live in California, which is great from a lockdown perspective, but unfortunately it's terrible from an insurance perspective because California has the most restrictive and innovation unfriendly laws or regulations around auto insurance, which is a real shame because I think Californians would love this product.
Yeah. So where are you located? What states can you offer the product?
So we launched literally at the very beginning of this month in Arizona. And so we now have real customers driving around. No accidents yet. So it's hard to know if we're predicting them right, but let's keep that up. We'll be rolling out to other states in the southwestern US over the next 12 months. So if we were to talk again 12 months from now, I would hope to be in Texas, New Mexico, Utah, and Colorado, as well as Arizona.
Yeah. So I'm curious as to how the state regulators in Arizona, your first state, how they interacted with you regarding this, because auto insurance is very old. It's been done the same way for a very long time. It was difficult enough for them to get the credit ratings in there. So your approach is a significant departure. And it sounds like it's even a significant departure from your competitors that are also pay per usage, so to speak.
Yes.
What was that interaction like with the regulators? How much pushback did they give on you, given that this is very different than what they're used to?
Well, I think it's an excellent question. And I have been enormously impressed by the regulators in Arizona. I went to go and see them for the first time in July last year. And we sketched out what we were trying to do in our plan. And their attitude throughout was, how can we help that happen in Arizona? How can we increase the choice of consumers in Arizona as far as their auto insurance? So from the start, they were terrifically helpful. Now, I think our product is going to be very attractive to regulators because of two things. Firstly, the nature of it, the ease at which you can get it, the low cash down element of this. This means that we're going to be insuring people who have not previously had insurance. 13% of cars in the US don't have insurance. Now, that compares to 1% in most other developed countries, even though that's the law. So we're going to help lower the number of uninsured cars on the road. The second thing is, we don't just judge whether you're a good driver. We also give you feedback in real time to reduce your chances of having an accident. And so our hope is that when we get to September, October, that we'll be able to turn up at the regulator and say, hey guys, we have 2,000 customers. Of our 2,000 customers, 1,000 didn't previously have insurance. So we're carrying out that mission. And of all of our customers, these customers are 25 or 30% less likely to have accidents than other people in their demographic group, because we've been able to tell them, show them how to drive better.
Yeah, no, that's, I didn't even think of it that way. That's, I would have imagined the regulator pushing back just simply because, they always have issues around making sure that it's affordable, but that's what you're doing. You're making it extremely affordable. And I didn't realize that the uninsured driving problem was that in depth. I would have guessed single digits versus 13%. That's pretty bad. That's 1 in 10 drivers around you potentially don't have insurance.
That's why you should always tick the uninsured, underinsured coverage box.
Tip for everyone at home. You heard it here. You heard it here first. Always accept that coverage. So as part of your business model, are you the risk taker on this, or do you have a carrier that you're working with?
That's right. We are we're a full stack carrier. We are looking to partner with reinsurers, but right now we're carrying all the risk.
Yep. Can you talk a little bit about the discussion that you potentially had when you started about whether to go in that direction and why you ended up choosing that versus going the MGA direction, which is what a lot of other startups end up doing, myself included?
So that is a genuinely excellent question. And we spent a lot of time talking about this early on. Really, there were 3 reasons why we went the carrier route. Firstly, going the MGA route before you have any real data is expensive. To give you that regulatory cover and to use someone else's balance sheet, you are seeing typically fairly, 8-10% of your premiums are going to be going out to your partner for somebody who hopefully shouldn't be bearing any real risk at all. So it's expensive. The second thing is that we are looking to iterate our pricing model every month. So we're looking to add additional features into how we price risk all the time. And that means that every month we want to go to the Department of Insurance and say, hey guys, here's our new rate filing. The crucial part is page 262, where we've introduced the following 3 factors. And here's our analysis of what this does to people's rates based upon that. And when we spoke to insurers about at the beginning of the MGA route, they were quite uncomfortable about making rate filings at that pace. And they were also, because we hadn't quite settled on the model of the 30 days yet, they were also very confused about a situation where you might have customers effectively on 12 different rate plans because you've filed new ones every month over the course of the year. And they thought this was going to be difficult, and they really weren't keen on our model. And then the final thing is, what we're doing is really quite sophisticated on the telematic side. I mentioned the traffic signal thing. We don't really want to share it with a competitor because no matter how many NDAs are signed, you can't. Once somebody knows something,
You can't
they can't
unlearn
unknow it.
That's so very true. That's so very true. And I generally recommend for folks that are starting to go the MGA route. You have one of the few use cases where it absolutely makes sense, where there's something particular about your business model where you need the control on it, and you can't have the carrier that's backing you basically pushing back so hard on your model that they change it and make it theirs. It's essentially a slight deviation from what they're already used to. You have different elements all throughout the chain that requires you to make sure that in order for this to work and for us to test this out to see if it works, we need control over this. And that's generally something a carrier backer is not really willing to do.
I think that's right. So it's interesting you say that because we were speaking to Greenlight, who I'm sure you know is a reasonable sized auto reinsurer, and they said to us, they said we see a lot of insurtech startups, and they usually do one thing different. I said, you guys, you do everything different.
Yeah.
Which is probably due to ignorance.
That's true. So let's talk about that, because there's so much different there here, and you're right, because generally when I see new insurtechs, there's not that much different than the policy form might be considerably, they may have a customer interaction element, a customer experience that's different, but the policy form is the same as it always is, or there's always so much that's the same. It's just like, you really didn't need to have the expense of getting a carrier set up, but you need distinctive rating, policy forms, speed of the filings, basically almost every element of the auto piece. That's, as an insurance expert, if you came to me and said, Nick, we need some advice, I probably would have talked you out of it. I probably would have said, Robert, that's a lot. Like it could take you years to kind of get this off the ground. So talk about that ignorance. Talk about, as you were going through, how were you able to get this successfully through? And I would say a fairly short period of time.
Well, it's interesting. So I have a theory, and this theory could, of course, be complete rubbish. But my theory is that so many great companies are started by young people because young people don't know how things are supposed to be, and they started from scratch. Now, I knew a reasonable amount about how to price risk. I had my ideas about how to tell whether a car would have an accident that were probably quite good, but I didn't have any real idea about how auto insurance worked. But what I did see very early on was that trying to put telematics pricing into a traditional business model doesn't work.
Yeah.
And I think that really was, so from the start, we were thinking always, how do we make insurance that works for telematics?
Yeah.
Now, let me address the other question. How do we do it so quickly? The answer is I am incredibly lucky. I'm incredibly lucky that I have this incredible team who have worked 24 hours a day for 14 months to build this product and get this into the hands of consumers. And, our reviews that we've been getting so far from our customers have been just amazing. I'm just hoping that we can keep this up and, build a really great insurance product, because there's no reason why you can't have a quarter of people in the US having some kind of on-demand auto insurance with real telematics pricing.
Yeah. Let's talk about your team. So as your who are the founders?
Yes. So the founders there's three of us. There's myself. There's our CTO, who's a guy called Murray McDonald, who's worked in insurance technology for 20 years. Was previously very senior in the tech team at Aspen Insurance. And then there's our sort of silent partner, who is our legal expert, a guy called Greg Ferkel, without whom we would never have been able to launch, because it turns out that the legals around launching an insurance company are rather complicated.
So that is exactly where I want to take these next set of questions and answers. I'm curious how you set this team up, and Did you know your co-founders ahead of time, or did you find them?
So yes, so like anybody with small children, you end up with a group of friends that are based almost entirely around your children's strengths. So my co-founder on the lawyer side is the general counsel of a large financial group, Greg, and he knew the insurance space very well, which was turned out to be very helpful. Whereas my current colleague Murray, I was his boss in his first ever job after university, and we'd stayed in touch. And it so happened that at the same time that I was developing this insurance idea with Greg, Murray's company got acquired. He was looking for something new, and so it was serendipitous.
Okay, so there are the founders. Now let's talk about how you began to assemble the rest of the team. What were you looking for, and how much did insurance expertise play into how you made your decisions as you rolled this out?
It's a good question. So the answer is, some parts of our business, we have an enormous need for real deep insurance industry expertise. So for example, our head of claims and customer experience is a man who's had almost 30 years of dealing with auto claims and built out claims organizations for large carriers.
Yeah.
Because this is somewhere where if I don't know what I'm doing, I'm going to get my face ripped off.
Yeah, and that's part of the business model that's likely not going to change from the traditional. Right. You're going to have an accident. Well, shit happens, but car needs to be repaired. How do we do it?
And we also need to make sure that we are doing all we can to evaluate that claim in a cost-efficient manner, and also to assess whether it was fraudulent or not, and to see the flags around there. And that's something, of course, that the traditional insurance industry has become exceptionally skillful at over the years, and it was important that we took those learnings. Likewise, our head of compliance, she is again a 20-year insurance industry veteran who's worked as head of compliance at other larger insurance companies. We know that particularly if we're going to roll out quickly, we need to have existing relationships with regulators, and we need to know what the regulatory environment looks like per state. Finally, our financial controller was previously the financial controller of Next Insurance. Again, you can't mess up your regulatory filings on the financial side. You have to have all those things in exactly the right spot. So those roles, those key roles, I needed insurance industry veterans, and I found them. On the app development side, the tech development side, I could be a little bit more, wide-looking in my approach. So, for example, our head of data science, a guy called Conan Snyder, he was formerly a very senior member of the Uber pricing team, because I want somebody who can think out of the box about different ways to price risk, and somebody with that experience. Likewise, our head of software engineering is a guy who has built backends and mobile apps for very serious and successful app startups in the past. And I needed somebody on that side of things and that experience, not necessarily somebody with an insurance bent.
That explains it. That explains all of it. I'm curious as to when you started this. Are you VC backed?
Not yet. So any VCs watching this, we are now live. We are now a company with real revenues, real premiums, and a 0% loss ratio.
That's always good.
So feel free to reach out.
Okay, so the question will be, you are full stack, so you have basically two giant buckets that you need to have quite flush with cash. One is the insurance carrier that needs to have surplus and all of that, but then your day-to-day business operation, the overhead. How did you manage that?
So we're quite fortunate. So the sports data business that I founded, Genius Sports, that was sold in 2018, which is why I'm here in the US. So I've been able to use the profits from that to fund this business. And I'm fortunate that I'm able to take it to a stage where I can prove out the core unit economics before I take on VC money.
Yep. I'm envious. I'm envious of that, and I'm envious of how fortunate you are, because at every stage you just were able to have the pieces come into place. How much of that do you think was truly fortunate, like in the luck sense, and how much of it was the experience of having gone through startups before? You sort of knew how to put a lot of the pieces together.
So I am a great believer that luck plays a far larger role in our lives than any of us like to admit. So the answer was, I was incredibly lucky that my former colleague Murray became available with his deep insurance industry expertise at the same time that Greg and I hatched up this idea. So that was pure good fortune, without which we would be nowhere near as far along with this project. I think we were also very fortunate that we found the right people in so many areas. So luck did play a role. But you also, you make your own luck to some extent. If we hadn't been working at 100 miles an hour, we wouldn't have got as lucky as we did.
Yeah. So I hate to throw out bad omens, but I think being a tech guy, there's a big push. There's a guy named Elon Musk and a few others who are pushing autonomous vehicles. How much calculation did that come into play as you were trying to design this startup? Because that's a big wrinkle.
Oh, that is going to fundamentally change the auto insurance industry. But there's two things I'd say about autonomous vehicles. So way back in the late 1990s, speech recognition arrived. And I remember getting, the IBM speech recognition thing, and it was really incredible. Back in 1998, 1999, you could speak to a computer slowly and it would understand you. And, when you saw this, and the ability to just read out a paragraph of text and it understood you, it was magic. But it was also useless, because it turned out that 99% accuracy was useless. And you have the same issue here with autonomous vehicles, which is that it's not good enough to be 99% good enough. You have to be 99.999% good enough.
Yeah.
And that's something we see here. And we see this, there are lots of really impressive demonstrations. And I think we're a long way away, though, from a situation where people are comfortable handing over control. The second thing, which I think is just important, if you think back to our customer segments, we like lower income drivers. We think they are underserved. Our customers don't drive vehicles with autonomous features. They don't drive vehicles with Apple CarPlay. Some of them don't even drive vehicles with Bluetooth or CD players. Some of our customers have tape decks. So you've got to think of it in those terms. Realistically, let's say autonomous driving comes along in 10 years' time. Well, our customers won't be driving those autonomous vehicles for another 20 years after.
Yeah, good point. I don't think a lot of people have connected the dots on how difficult it would be to steer the Titanic that is the global automotive industry. Not the building of cars, but getting them on the roads and how we use them. The culture around that is the Titanic, and moving it away from the iceberg it's too much of a task to do in such a short period of time.
That's right, and it's not just it's that edge case. When you come across something you haven't seen before, how is the machine able to deal with that? But how is also, this is a little off topic, but let's say that somebody walks out in front of your car, the autonomous vehicle is in control, and it can divert and miss that person, but in diverting it causes another accident. Mm-hmm. And it's got to judge at that point. Human beings, we accept human beings make difficult judgments. Are we willing to accept a computer making a decision about who gets run into?
No.
And so you put those together, and that tells me we are further away from
Yeah.
autonomous vehicles on the roads in real quantities than some people think.
Yeah. Very good points. Very good points. So how far away are we from just tenants insurance, just event cancellation? Like how far this, so your model has seeds that I think could be useful. So, we have all of these smart devices, but no one has really figured out how to get those into a homeowner's policy or whatever. And I think a lot of it has to do with how you described it, is you're taking this new technology and trying to shoehorn it into an old policy form that really wasn't meant to handle this new technology. It sounds like your particular model could work in a much more streamlined way, where we could get better homes with, safer from fire, theft, vandalism, water damage, all of that stuff. What are you thinking towards that?
I'm thinking
that
let's do
had to
auto
have crossed your
insurance
mind.
first. So auto insurance in the US alone is a $280 billion market.
Yep.
Okay. So I have 21, 22 people working incredibly hard on auto insurance right now. There is a massive opportunity long term to take my teams that know everything now about risk pricing and move them onto other things. And there's an opportunity as well to use that to change behavior. So people could see the financial consequences of, let's say, installing something that reduces their risk of a leak. But let's get this, let's do one thing well, not three things badly.
Yeah. I salute you. Opportunity cost. It's the most difficult thing that I have found in small business is there's so many different opportunities. Which ones do we work on? Prioritizing that is extremely difficult. I will be the first one to tell you, I get pulled into so many different things just because they sound really interesting. They could be new opportunities. It could lead to something. And then you sort of look back and say, oh, not that I wasted a lot of time on it, but I'm spread so thin, I can't devote the necessary energy. And you have done the hard work of saying, no, we're going to focus on this. So I commend you.
Well, it's interesting you say that, because I remember reading that Sergey and Larry at Google would always, at the beginning of every meeting, they'd say the decisions we're making here have to recognize the biggest cost is opportunity cost. What is it that we're not doing because we do this? And I think that is anybody running a small business has to be aware of that all the time.
Yeah. No, perfect way to end this phenomenal. As a matter of fact, I don't want to end it. Let's because one more thing, since I'm going to sign off and tell everybody to stay safe. We do have this pandemic, and you kind of alluded to this. This is both good and bad for your business.
Yes.
One of the really interesting parts is in your business model, you don't have to give credits back.
No.
Your business model is already completely set up for a scenario just like this. But can the business, the model, the way you set up, can it survive if we go through in a very extensive period of time, which we may, where people aren't driving?
The answer is yes. And I think the reason is because right now, if you're on, it might be the case that the number of miles driven has fallen by 50%. I would estimate the number of accidents has fallen 75%. So, even in an environment where people are driving less, I think the margins for auto insurers are better, even in a per mile world, simply because there aren't the cars on the road for you to crash into.
Yeah.
and one last thought for me: no one's driving home from bars drunk either.
Yes, very good point. Awesome way to end this. It's a pleasure to meet you.
Real pleasure to meet you too.
I mentioned before we started recording. This is you're the founder of Python Anywhere, right? Not just
I am. Yes.
Yes. So for those that are listening, and I know there are quants and math nerds on here. Python Anywhere. It's this guy, or this guy right here is the founder. I had just signed up for it. Being in this pandemic, I wanted to come out of it with some sort of skill set. I always wanted to learn R or Python. I chose Python. I joined Python Anywhere. I was going through Robert's CV, and there it is. I'm just like, this is such an ironic world that we live in, that I get to get to have conversations with such interesting people.
And Nick, it's been a pleasure from me too. Thank you very much for your time.
Okay, so for those that are listening, as usual, stay safe, wash your hands, keep your distance, be respectful, and until next time, thank you very much.
And so, my fellow Americans, ask not what your country can do for you, ask what you can do for your country.